Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They are for information only. Always start here with the monthly or the weekly chart, I should say, of the S&P 500. And as you can see here, there's a bear market that was through 22, and then the bull market we've had the last couple of years. And had some support points raised up here, 5,700. In recent videos, I said we were kind of going sideways for the last 6 months, and we had. And then in recent weeks, we've actually broken down through some of that support level to start a bit of a correction at this point where we had been off somewhere around 10% on the S&P. It was bigger on the NASDAQ. But we'll see what happens from there. I did highlight some other support points, potential support points in here around 5,300, also around 5,000 to see where the market might try to find its footing. But as you see, I mean, in day to day, it feels like a lot, and 10% can be a lot for people. But if you look at the chart, it's not unheard of that we would have those kinds of moments in the market. So for the moment, it is kind of time to be a little more conservative about things. I would not be aggressive in these markets as they have broken down from an uptrend or actually from a sideways to a downtrend, but it's not excessive as of yet. We come down here to daily chart. It is these controls so people see better. Here it is. You can see the breakdown from the daily chart. That we had a nice channel that we were running up there the last year or so, and it's broken down here now, and we'll see how far it goes. It's basically a issue with a potential recession because of maybe some of these tariff threats or not threats, tariffs, and seeing how they may shake out and what they might do to the economy. No way to really tell how that will work out as of yet, but it's spooking the market for the time being. So here you can see we broke down. Our weekly chart is down, our daily chart is down. So we certainly want to be cautious. But we generally see that a lot of times markets break down from a level and then they go back and they retest it. So it wouldn't be surprising for us to see a bounce here. And I think we're already seeing that. Today, the market's up pretty nicely this morning. So maybe we retest, go up a little higher, and then decide to see what's going to happen from there. Come down here to our 2-hour chart. This gives us about the last 6 months trading in the market. You can see the downtrend that we've had, and certainly the last couple of weeks, it's just been sort of straight down or a lot of failed rallies where intraday the market will be up a bit. People were just selling into that and moving their bets around, so to speak, on what sectors and companies would be successful here in this environment. But as of right now, we did hit the bottom of that channel, as you can see, and generally then you might see something work back where we try a little bit higher. And that's the case, it might be a good opportunity for people to readjust their portfolios if they haven't already done some de-risking of it. We got a little cautious a bit of a while ago, as I had been pointing out here, is see the valuation in the market. I mean, we're really overvalued. That the 4,000 is about where the market should have been at 20 times earnings. We were way above that at 6,000. So it's really probably a good thing for us to sort of have these, as you can see in the chart, sort of corrections back to normal once in a while. Not calling for it to go to 4,000 or anything, but maybe some correction is a normal thing. We come here to interest rates. This is the rate on the 10-year U.S. Treasury bond. Still flat in the middle there as it's been for the last couple of years, right at 4.3. Staying put, so we're not getting any real movement in interest rates as of yet. Stability there. We look at the economic picture here, GDP growth rate 2.3, 2.5. Those are solid numbers. We're not seeing a recession yet. The data isn't there. I'm not saying that couldn't happen, but it's not there as of yet. Try not to react until we actually see data. These are decent numbers, not great, but fine. Payrolls, U.S. farm payrolls, we're still seeing positive numbers there. Maybe some of the government layoffs and things haven't hit yet, so we may see that. But these are still fine. They're still positive, so not not any, at least from the data, we're not seeing any recession in sight as of yet. The one concerning thing I have here on the economic data is retail sales are negative last month. They had been low, and now they're going to negative. So the consumer is slowing down their spending, getting a little worried about what might be happening. So little cause for concern there. Let me see here too. I forgot to go through the breadth measures we have on the market. You can see here as we came up to all-time highs, came through February. This is the percentage of the S&P 500 that's in an uptrend. You can see here we were rolling off to lower numbers as we went, indicating a sign of trouble. I mean, here that's an all-time high right there, and boom, we were only at half of the S&P 500 was in an uptrend. So it was telling you might want to be careful. Right now it's at 36, but that's usually a place to bottom from. We're normally seeing those kind of numbers where the market rallies from those levels. So and I expect we'll see that a little bit, even if it is just a short term, but it may give some people an opportunity to make some adjustments there. Also, this is the advanced decline line on the New York Stock Exchange rolling off. So a little bit of volume coming through, but not a panic level of selling right now. Almost looks just more like a readjustment out of certain areas into others, as trying to figure out who the winners and losers of the tariff thing might be. Finally, the bottom, this is the VIX, the volatility index. This is the cost of insurance for portfolios in the options market. And we often see these spikes when you get sell-offs. Like here, you get sell-off, and then when the volatility finally rolls back lower, that's usually a place where you might see a bit of a rally. As you can see here, works its way lower, and then okay, then market follows. We are seeing a bit of a roll-off here today. Who knows? By the end of the day, that could change again, but for right now, it is rolling off. So. And then finally, want to look at operating earnings on the S&P 500. This is analysts' estimate of what we might see going forward, and they're still looking at going out to Q4 of next year that earnings are going to be very good for the S&P 500. So they're still not calling for any kind of earnings recession or roll off with that. They could be wrong, but not seeing it yet. So certainly some economic data that's slowing. We had a market that was overvalued and in need of a correction. And if we come here to the weekly chart, sure, it's just been up without a problem here for, you're working on 2 years. So that's a normal, healthy thing. And then we'll just see what develops from there. So anyway, hope that is helpful. I'm going to try to put up here. Oh yeah, there's our contact information. If you'd like to hear more about what we're doing to help protect people in these times, or how we could help with your portfolio, please don't hesitate to reach out. Otherwise, I hope this was informative and helpful, and we'll see you at the next update. Thanks so much.